Well, hello everybody and welcome to this episode of Savvy Investors at VectorVest. My name is Susan HayesCulleton and I'm the host of the show, and I'm really happy to see you all here today. Today we are going to talk about something that has been on my mind for a while, and that is the reasons people don't invest in the stock market. Now, what I am not going to try to do is to convince anybody here today that what I do want to do though is critically analyze the reason that people may not consider the stock market and see whether the idea or the rationale that they have like that is valid, or whether they may need a different perspective and accordingly. Lots and lots of us have our own preconceived notions of what it is or how well it performs, and particularly if you read the book, for example, The Psychology of Money, it's a really good read. I would recommend it to anybody who is interested in not just the stock market and not just personal finance, but the stock market, personal finance and psychology all together in a very accessible way. It's a great read. But in particular, what stands out in that book is that the time at which we're coming of age can often have a disproportionate impact on our views of the stock market. So if I was just coming of age around the time of 2008, I might have a very different view of what the stock market is than if I was coming of age perhaps in 2004 or any other time back through history as well. So on that note, today what I wanted to do was look at the reasons people don't invest, and then let's figure out why that might be and see if the idea indeed. Just in case any of you are here for the first time, my name is Susan HayesCulleton and I am really delighted to be here with you here today. And as I say, I am the host of this show, Savvy Investors at VectorVest. And I'm going to tell you a little bit about why we started this show. But before I do, I think I'm getting a message here, if I am correct, that I just need to sort out my microphone here. So I'm just going to check out here. Is that better for everyone? I see there was an issue with the audio. Just checking there. Testing 1, 2, 3, 4. Are we okay? How does that sound to you? Might just get some feedback there from everybody. Let me know if you can hear me okay now. And so far I'm not hearing anything, but I know there's a difference between what appears on my screen. Okay, great stuff. Great stuff indeed. Delighted to hear that. So I'll just tell you a little bit about Savvy Investors at VectorVest. We created this show because I wanted to bring some ideas to the table here where I think sometimes they can be misunderstood. The first ever episode of this show was how to read an earnings report. And this week there's lots of them out. Tonight we're going to hear from Amazon. During the week we heard from Microsoft. We heard from Meta, both of which have been enabling the tech sector to be showing much better gains this week. Last week we had Coca-Cola. We've also had, in recent times, Skillsoft. We've had Carnival. Like we're well and truly into earnings season, and of course, First Republic as well. Do I need to say more there? So I wanted to show people really and truly how to navigate things that I just don't think always gets the best attention. And also, I'm very fortunate within this show that other people are giving up their time to be here with me as well from time to time. So I've interviewed Steve Chappell about how do people really learn about the stock market. And if you haven't seen that episode, I highly recommend that you do, because he shares some really great insights from his years of not just investing himself and not just trading himself, but also delving right in and understanding how other people learn, so that then we can put that into action as well. And today, Savvy Investors at VectorVest, like I mentioned, is going to be all about why people don't invest in the stock market. And I just invite you to stick with me to see if I can help you understand that from a different perspective. And as always, I'd love if this show is highly interactive with everybody. So what I'm going to do now is I'm going to ask everybody to let me know, where are you tuning in from? What part of the world are you tuning in from indeed? So I am going to check out here to see where everybody is joining me from today. So I'm going to start off here, right up here at the top, and give everyone a shout out. Dave is joining us from St. Louis, and Bill Martin is joining us from the Big D in Texas. I would imagine that's Dallas, perhaps. Who else have we got here? And thank you very much. to Joey, who says, VV Nation, let's all welcome Susan. Ah, you're very good. Jimmer is joining us from Phoenix, Arizona. Lyle is joining us from A. Hello, Lyle, you're very welcome. I'm not sure where A is, but please do feel free to let us know. And let me see, Bill is also joining us from St. Louis. Frank is joining us from Kansas. Dave is joining us, West County, sorry. I can see that chat is continuing there between a couple of you. Great to hear now that the sound is all good. That's great. And Francisco is joining us from Chicago. Bill is joining us from Chesterfield. Dave is joining us from St. Louis, Missouri. Oh, Christian, hello and how are you? Is joining us from Belgium. G. Swill is joining us from Chicago. Tom is joining us from Brunswick in Maine. Who else have we got here? Bill is joining us from Alberta, Canada. Guido is joining us from Belgium. Maria from New York City. Michael is joining us from Marvin from Mars. Okay. Susan is joining us from Florida. Hello, Susan. Great to have you back with us again. Sue is joining us from Wales, and you too, Sue. SI is joining us from Costa Rica. Great to have you back too. Ahmed is joining us from Dallas. George is joining us from Cheshire, Connecticut. Interesting, we have a broader audience today. The last episode, there was lots and lots of people from the States. The episode before, there was lots and lots of people from Canada. So make sure that you have your area, your geography represented. Lyle is joining us from Camrose, Alberta, Canada. Dirk, you're very welcome indeed. Dirk is joining us from Belgium as well. Great to have you here. Really and truly delighted to have you all here indeed. Okay, now let's get down to business. The 10 reasons that I think, and based on the research that I've done, that people don't invest in the stock market is the following. I'm going to list them all out, and then I'd love if you would tell me in the chat which ones particularly stand out to you. I'll spend more time on those if you'd like me to, and I will go through them all today. And I'm also going to do that where we take care of everything within the hour, because I am very respectful for people's time, and I know that each of you are giving up time in your morning, noon, or night to be here with me today. Raluno, you're joining us from New Jersey, beautiful part of the world, you're very welcome. And Mick Ifate is joining us from Rockland, Maryland, outside of DC. I actually know it, would you believe? I do indeed know it. Okay, here we go. Here are the 10 areas, or the 10 reasons that I think people don't invest in the stock market. Please do pop them there into the chat. Tell me which ones resonate with you, and then I'm going to go through them all in a rapid fire round in a super action-packed episode today. Number 1. And not in any particular order, so not in order of rank or importance, simply in chronological order of how I'm going to run today. Number 1 is volatility. People do not like volatility. We see First Republic having dropped 50% of their share price in their last day. We've seen the pop in earnings that then led to the pop in the share price in Microsoft. We see Carnival being a very rocky type of a stock. So volatility is certainly one reason that people can not like it. Okay. Number 2, market crashes. We saw a big one in 2020. We saw a really big one in 2008. We have seen the flash crash in 2013. We saw the big one back in 2001 when it was the tech bubble bursting. So when we look at market crashes, we saw the tech sector particularly towards the end of last year, but all of last year towards the end of 2021, throughout much of last year, and then the rally started towards the end of last year in the tech sector. But 2022 was a very, very, very tough year in the stock market. So stock crashes, of course, I understand. Number 3, complexity. Complexity is that it's a complex place. I have my own views on that, which I'm going to share with you, but number 3 is complexity. Number 4 is you have a lack of control. Is that you can't control the outcomes. Control. Again, I have my own views on that, which I'm going to share with you today. Number 5 is that it's emotional. It is. It's an emotional place to be. It's an emotional place to be because you can sometimes feel hurt by the stock market. You can feel loyal to a stock that has done very well for you in the past. You can feel like you know a company very well because you work for it, client of it, or you have been a supplier into it. It can be an emotional place. Number 6, high fees. Changing, but okay, high fees. Number 7, if you've limited diversification, and that can really hurt. For example, 2022, and if you had Meta, if you had Coinbase, if you had Microsoft, if you had Cisco, if you had Intel, then of course you would have had a lack of diversification. Global companies, yes. In the one sector, yes. And affected by the same things. Number 8 is that it's time consuming. It can be time consuming when it comes to investing. Number 9, a lack of guarantees. You don't know what's going to happen at all, and you certainly don't know what's going to happen by a certain time frame. And then number 10 is that you do have alternative options, well, alternative investment options. So let's take them from the top. Now, of those 10, volatility, market crashes, complexity, lack of control, emotional investing, high fees, limited diversification, time consuming, lack of guarantees, and alternative investment options. I'd love to hear from you. What do you think is the issue? What do you think holds people back? What holds you back? Or maybe what part of that do you not like? I'm going to pop on over here and take a look and see what you're saying. SI says, the reason I don't believe in the stock market is because their valuations are extremely exuberant. That is true on occasion, SI. I would certainly say not all the time. If you were investing in the second week of April 2020, that would have been an example of when valuations were completely off. They were far from irrationally exuberant. John says, John is here from Adel, Quebec in Canada. Hello, John, and I'm delighted to hear that we're getting more representation from Canada. Cecilia says, excellent and thorough marketing research, meaning so true. Thank you, Cecilia, you're very good. Fitness Solution said you nailed all of them. Okay, Fitness Solution. Now, let's get in here though, and let's see whether what I'm about to say to you is something that gives you an alternative perspective on that, or whether you say, yeah, even though I have the alternative perspective, that's the way I'm going to stay. Susan says, time consuming and volatility, finding good information. I think I would hopefully be able to help you in all three there, Susan. Dave says, extreme uncertainty. Yeah, there is, Dave, but let me give you, again, an alternative perspective on it. Fitness Solution says, I feel like stocks are often manipulated by the biggest sellers. Short selling and drives prices down. Okay, let's get in and let's get started. Right, volatility. Here is my take on that. So what I'm going to do is I'm going to bring you into, I've actually the European system open twice. So I'm going to close one of those. And now I have got my US system. Yeah, I've got my US system here instead. So let me bring you over here and let's start with volatility. Okay. So when it comes to volatility, my own take on that is that indeed there can be a lot of volatility that happens in the market. Like, number one, I'm not going to say that it doesn't happen. Of course it happens. It absolutely happens. The question is, how do you make volatility your friend? So if I was to look at a couple of stocks that have been particularly volatile in recent times, I am going to take First Republic. I'm going to take First Republic. I am going to take Lululemon. I'm going to take Carnival. CCL, and I'm going to take this week's Meta. Okay. Now, let me graph those, and let's just take a look at all of those on a graph, and let me just exemplify what I'm talking about. Like, there we go. Here in the case of Lululemon, on the day of the earnings release, I remember watching it. In fact, I was talking through one of the Savvy Investors shows very close to that period of time. So as you can see here, the absolute massive volatility here, stock gapped up, and as you can see, has continued to rise since. Okay, that was Lululemon. Meta, again, you can see here, easily beat its earnings, easily beat its revenue as well, and had a super quarter, as you can see here, gapped up, right? So very significant volatility. So I've shown you two stocks there where the volatility has been good. First Republic, on the other hand, of course, we saw First Republic went from $147 a share and then down to $12 a share when we had all of that carry on there with Silicon Valley Bank. And in the past 3 days, this is what's happened here as well. So particularly from the 24th of April, then there was an announcement around the amount of withdrawals that was happening, how much money they were losing was 130 billion. They're also talking about laying off between 20 to 25% of their staff as well. And they did not, interestingly, have a Q&A in their earnings call either. So as you can see, since then, we've seen the stock go from a high, if you could call it that, of $16 down to $6. So that stock has really, really been hurt badly. And let me give you one more then. The one that I'm going to just focus on here is Carnival. Now that has showing you a lot less volatility than what any of the others have been showing you in recent times. But my point is that absolutely volatility happens in the market. And I've picked particularly volatile ones. I've picked particularly volatile ones because First Republic, of course, had that news that came out. Lululemon and Meta, both that volatility was particularly driven by earnings. Carnival is a different story. Carnival is just volatile a lot of the time anyway. The question is, how do we turn it to our advantage? So I'm going to very quickly show you how I turn something like this to an advantage. In the case of Carnival, now as you can see here, it's got a sell recommendation, right? It's the share price is now 8.75, and if I scroll over here a little bit, the stop price here is 9.20. Okay, the RT of this stock is at 0.55, and as I mentioned, it is very, very, very volatile. If I was to take another very volatile stock, one that has been volatile all the time, silver, for example, the ETF in silver, and actually, I want to take silver instead for the example that I want to show you. Silver, generally speaking, is a particularly volatile stock. It has always been referred to as the more volatile of, or gold's more volatile first cousin. Now, over here we can see in this case, which is better than what I had wanted to show you in Carnival, is the RT is 1.33. Stock is rising, okay? But since we can see here that the RT is significantly above 1, it's rising in a volatile way. So what I'm going to show you is I'm going to show you how to get paid for volatility. So I'm going to open the options analyzer. And let's say that I was going to take a position in silver, right? I can, of course, take a position in silver and I can analyze it accordingly and I can do all of those sorts of things. But what about if I was to do something else instead? What about if I was to sell to you, right? You, whoever you are, joining me from wherever you're joining me, I would sell you the right, but not the obligation to sell it to me. What that means is that you would pay me a premium. You would pay me a premium to lock in a price that you would like to sell silver to me on. Now, let me just I want to walk through an example of this. So I have my stock here, and I am going to say, here's what we're going to do. I'm going to pick July. Or have I got July? Yep. In July, I am saying to you that I will buy silver off you if you want me to. Currently, silver is trading at $22.84. I am saying to you that I will buy it off you at $22.50. In other words, the price roundabout today. Michael says, so you want to be an insurance company. Stick with me, Michael, and let me just walk through this example, and then I'm going to point out what you're talking about. So what it means here is that I'm saying I will buy it off you in a couple of months' time at the price a little bit lower than what it's trading at today. Okay? Now, if I was to do that, it's saying right now that I would get 75 cents per share. 75 cents per share is that if I was to do this for one contract, I would have to do this for 100 shares at a time. So I would get paid $75 right now in order for me to lock in that price, to buy it off you at a lower price than it is today in a couple of months' time. So you might say, hang on a second now, Susan, you're telling me that I could pay a lower price for the stock in 3 months' time that it's trading at today. And in addition, I would get paid to do that. So I'm getting paid twice. I'm able to buy it at a lower price than what it's trading at today, and I would get a premium. And I would say, yes, the answer to that is correct. So in that way, you're getting paid in order to buy the stock. So why are you getting paid? Well, 3 reasons. Is let's say that you want to lock in that price. So you know you want to sell it to me at that. But if the share price is higher, well then you want to keep the stock and not sell it to me at all. So what you're doing is you're locking in the option, the right, but not the obligation, to sell it to me at that point in the future. But if the share price goes a lot higher, well then you simply keep the stock and I simply keep $75. So the reason that I would get paid that is, number one, is you're locking in a share price for a period of time, all-time value. Number two, you're also locking in that share price for a period of time. And I know I've said that already, but the period of time, but you're also locking in the price. So they don't have to worry about the volatility that happens between. And number three is because silver isn't inherently volatile anyway, you're getting paid to absorb the risk of that other person. So that's the way in which you could turn volatility into your friend. Now, Michael says, so you want to be an insurance company. The way I would look at that, Michael, is you could say that, is that I'm insuring the share price of you, let's say, because you want to lock in a price on the way down, so you know you can sell it to me at $22.50. But on the other hand, the way I see it is you're paying me to buy a stock that I might be bullish on in the first place, simply paying me to wait. Of course, the risk then, Michael, is not, of course, that the stock price will go down. Of course, there's that risk anyway. The risk is that it would go way up and I could have bought it anyway. So that's why that might be the case. So that's what I'm saying, is that you can turn volatility into being your friend. If any of you are interested in learning more about that, what I've just described to you is selling an option so that you can get paid to take the risk of the volatility. You can get paid very directly. Now, that was number one. Number two is market crashes. How do we avoid being involved in a market crash? Okay, very simple answer to that. And that is using market timing. Now here on VectorVest, actually, just in case any of you are not familiar with the VectorVest system and you want to try out what I'm doing here, Joey, can I ask you kindly to put the link to taking a trial into the chat, please? So that people can do exactly as I'm doing, try it all out, see if they like it, see how it works, and just get the most value out of the session. And of course, also, if any of you are on if any of you do have VectorVest, open up your system now and walk along this with me. And of course, if you're not joining me live, all of this as well is being streamed live onto YouTube, so you can check out the recording at any stage. Now, Waz Wilton says, can you do this in the EU and the UK? Yes, you can. I just want to make one important distinction. If you do it in the UK, then the option contract, so the number of stocks within an option contract is 1,000, not 100. Important distinction there. You can indeed do it in the EU as well. What I will also just point out is that every stock that you see here that I've put in front of you, there's an X beside the exchange letter, which means it's optionable. You need to make sure that a stock has a certain amount of liquidity to be able to do. Okay, now I'm going to move on to my next point, which is how do we avoid market crashes? The answer is by having an effective market timing indicator. That is how you do that. So I'm going to pop on over here to timing. There are a range of market timing indicators in here, depending on who you are. Now, quick question to you all. How many of you would consider yourselves traders? How many of you would consider yourselves more medium-term investors? How many of you are neither, because you're simply learning at the moment and waiting to take a decision on that? So my question is, are you an investor, a longer term investor? Are you a trader? Or are you somebody that's simply learning and getting started? Michael says both. Okay. And of course you absolutely can. Fitness Solutions says long-term investor. Okay. Personally speaking, I'm probably more of the longer term investor, but I do like options. So often my activity when it comes to options would be viewed more as a trader, I suppose, but it's with a view to taking a longer term position. Okay, I can see there we've got a bit of everything. Chris is a trader mostly, Rakesh is learning, Christian medium term, Susan learning and losing. Let's see if we can help you out with that, Susan. Okay, so no matter who you are, there is a market timing indicator in here. What I'm going to do, based on what I'm seeing here, is that I'm going to take the longer term investor sort of approach. That seems to be the people, that seems to be representative mostly of the people who are answering. Now, there's also market timing explained over here, so you can pop in there and learn all about this, but I'm just going to go straight to the point, and I'm going to show you a market timing graph. Here we go. Now, in here, I'm going to show you an indicator that works on a more medium-term basis, and that, like I said, Tom is more medium, he says, Christian is more medium, Fitness Terms, our solution said, long-term investor, so give her, and Michael is both right. MTI. So the market timing indicator here is a system where it is quite simple to read. Above one is favorable, below one is unfavorable. That's it. Market timing indicator. Above one is favorable, below one is unfavorable. So when was the market timing indicator suggesting to get out of the market? Right here. Right here. Now, hard for me to keep my mouse exactly straight here. But at that stage, we were looking at the price of the VectorVest composite being at 58 up here. Is long-term investing 5 years? Lyle, I don't think so. I think longer-term investing would be more 1 to 5 years. That's more where I would be considering that myself. But people have different views on that. John is both as well. Okay, great. So as you can see here, that's when the market timing indicator was saying to get out. Now, there was a whipsaw here. This is when the market timing indicator went below 1 and then back up over 1. So that was a whipsaw. And I would really challenge anybody to come back to me with a market timing indicator that works every single time in every single scenario. This one doesn't either, but what it does do is it has never missed a major market turn. And that's the key thing that I wanted to point out to you, is that knowing when those are is really important. So the market timing indicator was saying to get into the market on 6th of January 2023, and then to be in there until the 22nd of April. Sorry, 22nd of February. Now, as you can see, like, that's not, for any of you who's more medium or long term, I know people like you and me don't really like to be in and out of the market very often, and that is a short period of time to be in and out, but it was accurate. Now, let me bring you to another time, though. Let me show you when, like, the said the same thing for ages. And that would be, let me go back here again. Is that here? The MTI was saying to get back in on, this is round about 4th of November 2020. Now, I don't know how many of you really remember the stock market and its nuance in 2020, but it rocketed up over the summer of 2020. But then when we were like, oh, hold on, do we need to go back into lockdown, and maybe the vaccine's going to take longer, all that sort of thing was happening, and there was a lot of volatility happening towards the end of the year. But the MTI was saying to get back in there, not the 4th of November, I'd say it was the next day. It was, I'm going to say the 5th of November. And then it was stay in all the way up here to 23rd of March. It was just a little bit of a blip. Stay in, stay in, stay in. So you can see here is that the MTI was particularly pointing out about what to do when it comes to the market all during that period of time. And you can challenge me, like, well, you're not challenging me, you're challenging the system. You can go back to any period of time and ask that. Any period of time at all. The MTI was saying to get out on February. There we go. On the 23rd of February, that was when it was saying to get out, and it called it just right. You'd have missed all of that if you were following it. So my point is have a good market timing indicator. The one that I'm choosing to show you here is the market timing indicator at VectorVest. There's a range of them. You can't, if you're a trader, you can't afford to be leaving it that long. So we have the primary wave, and we have the green light indicator, and there's a range of others in there. But having a market timing indicator that is back tested and has substance, but also that is easy to interpret, is key to be able to avoid market timing crash. Now, I also want to show you over here that in Europe at the moment, we are in a different scenario. In Europe, we're at 1.01 in our market timing indicator, and we have been in, like, it's looked so different to the States. If I just take a look here at the graph, here we are. You can see here that we have been over 1 with our MTI since November of 2022. So as you can see, the market in Europe has been quite different, markedly different in Europe than it has been. Okay, that's number 2. Now, number 3. While the word is big, the answer is small. And what it here is that complexity. The market is full of complexity. If you listen to me, you'll hear that I listen to a lot of market timing. I listen to an awful lot of earnings calls. I listen to a lot of economic commentary. I listen to the Wall Street Breakfast every morning. I have my own show here at Savvy Investors. I have my own show on the ESG and Tech Show. You might say, whoa, Susan, like, that is a fair, that's a lot of time that you would put into it. That's an awful lot of information to assimilate before making decisions. Now, my answer to that is that the VectorVest system, though, is designed to make it simple. And I would really and truly encourage you, whatever you use, to make sure that your investing is not complex, but that it is simple. So what I would say is that a very simple way to make decisions is to pick a simple strategy and back it. The most simple one of all in the VectorVest system, in my opinion, is this one. Let me go, if any of you log into your trading system, right, or if any of you log into VectorVest right now, there's your homepage, right? Let's say that's where it starts. Now, next, if I go to viewer and I go to my stock viewer right here, and right here you can see a list of the top 10 VST stocks. You can see here, see this little arrow? That's telling me that that's ranking. That's it. There is no complexity, because the complexity is built in the back end. It's built into the algorithm in the back end. Now, let me explain what VST is to those of you who don't know. V is for value, S is for safety, T is for timing. V is for value, which is long-term price appreciation. S is for safety, which is predictability, and predictability and consistency of financial performance. T is for timing, which is the direction, magnitude of direction, and the dynamics of the share price. Now, you can go and decide and learn all about what all of those mean, and you can read books about it, and you can do all sorts, and I have done. If you don't want to, just bear in mind that all of what I've just said is packed into that number, which is, here we go, the top 10 VST stocks. And we're looking at the top stock here is First Citizen Bank. Tingo Group is at 1.49. Aon after that at 1.47. The VST operates in the same scale as what I showed you the market timing indicator. Above one is favourable, below one is unfavourable. The higher the better. So in this case, the lowest that we have here is Burford Capital at 1.38. The highest one that we've got is 1.57. If I was to go back to the beginning of the year, we go back here to the beginning of the year. Michael and I'm going to show everybody how to take your advice. Here we go back at the beginning of the year, and let me just check here. Now, what was at the top here? We had Super Micro CMP, Catalyst, Sterling, Fabrinet, LSI, AXS, Tesla Bear, UFP Tech, Direxion, Helix Energy. If I was to quick test all of those, there you can see so far that the price change has been minus 8.86%. In comparison, the S&P 500 has delivered 7.4. Now, you might say to me, does that not test the theory? You see, the thing is, though, remember what I said, is that the market timing indicator in the US has said that the market is not a good place to be. And that is how we have been making sure that we follow that direction. So let me now combine the two together. Let me look at over here. Let me go back and look at timing. Let me look at when was a good time to be investing in the US. Market time indicator, 6th of January, right? Let's go back here now. Let's look at the 6th of January. Over here, let's look at a view. And if we change the view here to 6th of January. So I'm going to go in here. It was the 9th, actually. It comes up there. Right, here we go. And here we would have our top 10 VST stocks. Now, from there, what I could do is look at how they performed in between that and the next period of time. Next period of time, if I go back over here to the market time graph. When was the confirmed, or sorry, when was it? The round about the 22nd of February. So let's check in here, okay? Give or take. Now, see the difference? Here we go. These stocks delivered 8.37% during that period of time, whereas the S&P 500 delivered a 2%. Now, you can go and you can back test any period again you want. Please do go ahead, test out how to do this yourself. But the point I'm making is that when you take market timing into consideration and then you take something simple like the top 10 VST stocks, that is how you can actually make the magic happen. And you can see the complexity here. The complexity is built in behind. VST, we've got value, we've got safety, we've got timing. It doesn't have to be complex for you, it can be complex for the system. And the system, of course, can handle it. You can try that out as well in Europe, you can try it in the UK, you can try it in Canada, try it in Australia, try it wherever you want. But the point here is that that is how you can factor all of that happening together. When you combine market timing simply and an indicator simply, that is how you can make it all happen pretty well. Okay, Maria says, good morning. That's why diversification is important. Hi, Maria. You are, or hi, Susan, she said. Hello, Maria. You're very welcome indeed. Delighted that you're here with us. Okay, now, also Michael says, if, at least he said, read Dr. D's green book if you're using VectorVest as your platform. I'm going to show you where to find that very quickly. If I bring you over here to, the welcome page, you can download the book here. That was written by our founder, Dr. Toledo, and it is there. There's actually been a new chapter added this year called The 7 Deadly Sins of Investing. I've written a series of essays around it in the VectorVest Europe views as well. Thank you indeed, Michael, for that piece of advice and for prompting me to share that with everybody. Okay, number 4, lack of control. So what do you do when you can't control the outcomes? All right, few things that I would say here. Number 1 is Unisearch. Is you can find whatever suits you. Unisearch is one of my favorite parts of the system. Unisearch is the way in which you find what you do like. So obviously I've shown you one method there that you can go in and look at the system is through VST, just like I've shown you. And that is where you simply go into the stock viewer. The list of stocks that appears straight away is a list of the top 10 VST. Now, how about though instead if you were to decide that you want to be super niche on what it is that you want? On this note, let's build this together. So can I ask you all to populate there, tell me there in the chat, what type of characteristics of stocks do you like to find? I'm going to start off. Number one is that I like to find stocks that has a VST above 1. I'm genuinely interested to hear what you have to say, so pop it there into the chat. So I would like it where the value, safety and timing of a stock is greater than 1. I would have always said before that I like a dividend yield above 2%. That, my opinion, and that has changed now that interest rates are the way they are. So now what I'm going to say is that instead, I would like to see a stock that has a growth rate, GRT. I want to see a stock that is growing its earnings by greater than 10% per year. I think that gives me a lot of scope to look for growth, and also it's also not looking for something that's really, really difficult to handle. What else have we got over here? Fitness Solutions says high RV. Yes, high RV is long-term price appreciation potential. You are indeed a longer-term investor if you're looking for that. So I am now going to say that I want RV to be greater than 1.2. Let's up the ante here, 1.2. What else have we got? Brian says positive EPS. Okay, so what Brian is looking for is a stock that is profitable. Okay, let me make that happen as well. EPS, earnings per share here, is greater than 0. Okay, yeah, very good. What else have we got here? Tom says high RS and high RT. Right, so I'm going to look for both. I want high RS and high RT. You know what, Tom? I'm going to again up the ante and I'm going to look for both. What I'm actually going to do is that when we run this search, I'm going to rank the stocks according to both. I'm going to multiply the two together and I'm going to rank them by. Now, Fitness Solution says EPS is rising. Okay, few ways we can do this. What I could do is take 2 points in time and say that I want the EPS to be X, and then I want the EPS to be a difference in comparison. So instead, what I'm going to do is that I want to say that the EPS has been rising over a period of time. How about that? So now what I'm going to say is that I want my EPS. So I've already said I want it to be profitable. Brian wants that. I want my EPS where I want the delta. Okay. And I want the delta. Yes. Over specific time. No, we go relative. And what I would like is for it to be greater than, I'm going to say 2%. Okay. The 10-day, maybe not 10-day delta, but maybe over 4 weeks. Let's give it 4 weeks. So I want it to be rising. Maybe that's too little. We'll see. What else have we got here? We want the exponential moving average 3 higher than the exponential moving average 8 right now. That might take me a little bit of time to put in, will it? Let me. Just try to see if we have something built around that already. See, have I got? That would take me just a little bit of time to build there, Brian. So I'm not going to do that right now, but I certainly will bear that in mind because I have to program in a few things. Cecilia there says CI. Okay, CI is an easy one. So CI is a comfort index, and that is where I want the stock's long-term, I want the stock's ability to withstand severe and/or lengthy price declines. Cecilia, I'm going to put that in there as well for 1. I want that to be greater than 1. High RS, high RT, and CI. Maria, I'm going to rank everything by RS and RT, and then finally I'm going to go with Mike's one. Mike is where the average volume. The average volume is here. Volume is greater than 100,000. Okay. 100, 100,000. 100,000. Yeah. Okay. Run the search. Let's see what have we got. There we go. A lot of those actually look similar to the stocks I showed you as the top 10 VST, because a lot of you are thinking, the way I'm hearing you, a lot of you are thinking like that. High value, high safety, high timing. But what I am going to do, and look at that 4-week delta. Look at that, 200% growth. Brian, sorry, not Brian. Yes, more Fitness Solutions actually. If you look at that there, you see that that's very, very significant. Now, what I'm going to do is I am going to, I just want to rank it. Here we go. So what I'm going to do is that my primary sort is, this is what I want to do now, is I want, and this is what I'm saying about programming things in that are pre-built already, is that I am going to look for RT multiplied by RS. RT multiplied by RS. RT multiplied by RS. Okay, it looks like that I'd have to program that in as well. So instead what I'm going to do is I'm actually, just because again to do it quickly, I'm actually going to use this one instead. I'm going to use RV plus RS plus RT. So that means that I must have the best RV and RS and RT together. So as an addition. Okay, here we go. Now, Fitness Solutions said, I don't trust a CI. I had a stock that had a CI of 1.7 in 2 months, dropped to 0.5 along with the stock crashing and founding. I'd be interested to know who that is actually. I'd like to know what that stock was. I'd like to just take a look at it and just to figure out there what might have been going on. The point I'm making here is that you can use Unisearch so that you can tailor a search to figure out exactly what it is that you like. You've seen me how to do the simple ones there. There's others, and there are plenty of more that I could do. And I'll tell you where to put them. Is what you can do is in here, when it comes to stocks and it goes to my custom fields, that's what I could do the EMA. That's when I could do the RV, RS multiplied by RT. That's when I can do a range of other things. Thank you for that. I'll take a look at that offline, Fitness Solutions, and I'm just going to take a look, and I just want to see what happened there, whether it was earnings, etc. Interesting point, Tommy. Yes, indeed, I could simply use VST. It's quite simple actually, and it's simpler to do that. That's what I mean. Chris says EPS is better if you put in that EPS is greater than EPS 6 months ago. That's what I was meaning, Chris, is that we could put in a time where in between the two. Let me just do that, and then I'll move on. So this is where I can put in time of search. I change this to say 6 months ago, you said, Chris. So I can say that the EPS then, yes. Actually, no, that's not going to work, is it? Because I need to exactly communicate when. Right, I'm getting into the weeds here now, but I'm just going to take that out there, because I am getting right into the weeds there. But you can point out if you want to change in it. There's ways and means of doing it, and there's a couple of ways of doing it. But if I get into it now, I'm going to be there for a while. But Chris's point is indeed very well made. I'm just going to come back to that sense of lack of control. So what I would say here is that the second thing to consider when it comes to lack of control is that you can always put in a stop. Now, let me just pop over here to Europe for a moment. This is a stock. I bought it ages ago, and it is one of our top 10. It was one of our top 10 VST. It is Saint ST. And I think we're a little bit frozen. Yeah, we are. It's not responding there. Oh, here we go. This is the stock here. So this has, the VST is currently 1.3. And I'm just going to show you a graph because it'll be easier. So it's one that I've had now for some time. I've had it really since it was the top VST stock in Europe. I think when I say ages, I had it around about the beginning of the year. So as you can see here, the stock has been rising and rising, and then as you can see, it topped up there, and it's now down here. It's what is slightly worrying at the moment is where it is bouncing off the MA at the moving average, the 100-day moving average. So I'm going to be keeping an eye on this. But the key thing I'm pointing out to here is that the stop loss is helping me understand when it is the time to do that. So when it comes to knowing how to understand or when to make a decision as regards the stock, or how do you make sure that a stock is sold at a time when you don't have to be watching it all the time? That is the way in which you can do it, is put a stop loss in place. VectorVest computes a stop for every single stock every single day. So here you can see now it's up today, or it was up yesterday by 1%. And the stop price here is 41.71. Currently the price is 42.30. Now that was at the close of the end of day yesterday. I bought it, gratefully, I bought it at a nice price below that. So therefore I'm up at the moment, but by actually having the stop loss in there, then it just means that I don't have to sit here and watch this all the time. So there are the two things that you can do. Number one is that if you want to tailor this to your own personal interests, well then of course you can at any stage decide how you want to run Unisearch. On the other hand, if you don't want to sit here and watch things every single day, then you can always put in a stop loss as well so that you sell at a period of time. And there's different types of stop losses, whether ratchet stop, etc. So that's what I would say. If you feel that you're having a lack of control, think about the type of variables that you want to control. Okay, the next few are a lot faster than here, by the way. So I will explain each of these, and I just want to give you a perspective. Let's see what you think. Number 5, emotional investing. Yes, it is emotional. It is certainly emotional. What I would say is the key thing to do is to remember why you bought a stock. Now, I told you I bought that stock because it was in the top 10 VST. It had value, it had safety. I know why I bought it. So when I see the stock now that it has fallen in the last period of time, the reason I bought is because of the VST. The reason I would sell is if it breaks the stop, or else if the VST dramatically falls, particularly in my case, falls below 1. That is what would determine if I was going to make a decision about that stock. As you can see, I'm being very unemotional about that, and I'm very objective about it. What I suggest though is that you journal, you document what you're buying and when you're buying it. And a way in which to do that, I would say, is I'm going to right click here, view the full stock graph. Here's where I do it. Okay? View your full stock graph. And then what I would suggest that you do is go in here, click on note. Okay? Put in your note. And your note, my note is here. So I'm going to say, I bought this stock on, I think it was January 23. And I, because it was the top VST stock database. Might say, Susan, why was this note not in here when we came in? It's because I took it off so that I could write it here again, or else you'd see it all. So it was top VST, because it was top VST stock on the database. I will sell if it goes below the VV stop, or if the VST falls below 1. And that is what I suggest about how to handle being emotional, is if you document what happens objectively and talk about what decision you will make in the future, that is the way that I personally deal with it. So that then when you can make your decisions before you have to make your decisions, that can often really deal with the issue. Okay, number 6, high fees. Okay, what I would say here is 2 things on that. Number 1 is minimize the cost of your investing. Minimize it. I have got 2 brokers. I use 2 online accounts, and the cost of my transactions is very minimal. It might be $1. It might be €1. And that goes for when I'm selling options as well, as that I have changed my account to make sure that when I'm buying and selling, whether it's options or stocks, that I am keeping the minimal. I'm keeping my costs minimal, because if it costs me a lot of money to buy a stock, or it doesn't cost me a lot of money to buy the stock, I still end up with the same stock. It's not like I'm getting any different stock. The only difference is the less that I have to pay to buy it, well then the more of it that I can have. So that's the first thing, is check out what the fees are. And I don't have time to go into it today, but there are lots of questions to ask your broker to make sure, or even look onto their site to make sure that you're not being exposed to exorbitant fees. Tommy says, I love the note feature. I can see it from any computer. Exactly, Tommy. Because of course, then your notes are on your graphs. And that's where I put them, is on the graphs. Also, I leave my lines there as well. I leave my lines. I'm looking at my bullish and bearish divergences. So I can go back and I can see the analysis that led me to picking a stock in the first place. The other thing is, a lot of people don't tell you this, is learn your lessons. Is as you learn, document what you're learning. It's something that I do all the time. It's something that I encourage people who work on my team to do all the time. Is, yes, you know, if you have to learn the same lesson over and over, then it gets very expensive. Learn your lesson by actually sitting down, writing what happened, what could I have done differently, why did I do this, did I have would I have made the same decision with the same amount of information that I had at the time? Because of course we often have imperfect information. So sometimes you can say, oh sugar, I should have sold that stock earlier. But would you have sold that stock earlier if you had the same information? Maybe not. And I know I made a mistake recently. I was listening to an earnings call. I know that business very well. I know the business really, really well. And I was listening to the earnings call and I understood it, and I could see where the opportunity was for the company. I could see all of that. And the business proposition is brilliant, and it probably still is, but the valuation was off. And I should have been more objective about that. If I don't learn that lesson, and I have learned from that since, but if I don't learn that lesson and I have to learn it again and again, then investing can get very expensive. Okay, number 7, limited diversification. You don't need to have limited diversification ever. If you have got a relatively small amount of money, then I would suggest that you look at ETFs instead. So the one that I had been looking at for you beforehand is this one. This is the most broad ETF that there is, and that is simply investing in the world stock market. The reason I picked this one is because if any of you are joining me from Europe, which I know some of you are, you're joining me from Belgium, well then in this case, you can see that if you are looking at a global stock market ETF, you would have to have it a UCITS ETF to be able to buy and sell it. For any of you who are joining from the US or Canada, you're not going to know what I'm talking about. It doesn't concern you because it's European regulation. For any of you joining me in the EU, you absolutely will know what I'm talking about. So that's why I picked this one. So this is a broad ETF. And this ETF is up, for example, 7.34% this year. Right? So this one is an ETF that simply tracks the global stock market. This has how many stocks? How many stocks does it? Holdings. 1,504 stocks. Look, 1,504 stocks. What are they? Apple, Microsoft, Amazon, Nvidia, Alphabet, Exxon, Meta, United Health, Johnson & Johnson. A lot of these have their news out quite recently. A lot of tech stocks in there because of their market value. Of course, as you may be aware, J&J are heading on a tour soon because they're planning to IPO Kenvu. And the other one, United Health, they had their earnings out recently. The only stock that isn't tech in there out of the top 7 is Exxon, actually. But anyway, they're only the top stocks. The main thing is that you have 1,504 stocks in there. But what I would suggest is that, going back to the point about volatility, going back to the point about lack of control, what I would definitely do is, I'm just going to look at this ticker, is IWRD. Check if I have it here, IWRD. Yeah, it's traded in Amsterdam. What I would be doing here is looking at the RT. Look at the relative timing, because of course what you want is an ETF that is rising. I showed you what it is on the year-to-date basis, but I would always check out as well the RT, looking at the relative timing, looking at the direction, the magnitude, and the dynamics of that price. Now, number 8. Number 8 is time consuming. And by the way, I know that I'm on number 8 with 6 minutes to go. So please do keep your questions and comments coming in here, because I know the clock is ticking. When it comes to the fact that it's time consuming, I like to invest time in it because I love the education. I love listening to an earnings call. I love listening to the conversation last week about the beige book in the US. I love looking at PCE figures. I love listening particularly to the Q&A of an earnings call, where you really hear the cut and thrust of what analysts are wondering when it comes to the business model, when it comes to the accounts, when it comes to competitive analysis. I'm intrigued by that. I think the education, worldly economic, business and accounting education that comes with the stock market is top class. But I'm not normal, right? Who is? But I wouldn't be your normal candidate. But that is time that I like to invest in because I feel that it's me time. However, what I will say is that it can be very, very, very minimal. You can take very minimal time in the stock market to invest. You can be super minimal. If you have got a market timing indicator, if you've got a clear strategy, or if you've got a market timing indicator and a couple of ETFs where you look at your RT as well, you could be managing your portfolio in an hour, a quarter. You really could. But what I will also say is that, and it's something I do myself, what I would also say is schedule a meeting with yourself, or even better, with people who have got influence over your finances. I don't know if every one of you know, but I wrote a book in 2013 called The Savvy Woman's Guide to Financial Freedom. And one of the chapters that I talk about in there is all about how other people have influence over your finance, like your partner, like your children, like the people that you work with, like your boss, like your pension provider. And I talk about making sure the communication is very good with all of those. But in particular, of course, the person who has the most influence over your finances is you. So what I suggest you do is do like me, is schedule a meeting with yourself. I like to do it on a particular Saturday, and I like sitting down, looking at my notes on VectorVest, looking at a couple of things that might be going on in my bank statement, looking at reviewing what's going on in my pension, looking at things like that, and just having that meeting with myself, taking the time to review different ETFs, look at trying out and backtesting different ideas in VectorVest. And it's enormously enjoyable, enormously, as well as highly productive. So you can put in whatever time you want, but it can be very minimal. But the important thing is that you if you're going to invest in the stock market, have your market timing and have your strategy. I've shown you a couple of simple ones there. Of course, you can attend any one of our YouTube lives and you'll hear a lot more. But take your time and do that, and then pick it and back it and go and schedule that meeting with you. Now, number 9 is that there is a lack of guarantees in the stock market. Yes, it is. Yes, it is. I agree. That is for sure. But again, let me just go back to the research that I've been doing on this. Well, that I've looked at. I mean, anybody that has looked at this over time, anybody that knows anything about the financial markets will tell you that the stock market outperforms the bond market. Why is that? It's because the stock market is an inherently riskier place. People would not invest in the stock market if they're not being paid more, if they're not being rewarded more than in the bond market, particularly the government bond market. We're at an interesting point in our time at the moment. I listened to a show called The Real Yield in Bloomberg. It's on a Friday. And I was just listening to the episode last week, 45 minutes on Bloomberg. And it was just talking about the time that, or the fact is that in a very long time, savers, people who lent money to the government or lent money to banks or lent money to companies, savers and bond investors, have not been getting real yield in a very long time. They have not been getting any return over and above inflation for a very long time. Now they are. And this is an interesting point in time, and this is why you see a lot of money that's moving out of the stock market, the bond market. There's a lot more money going into government bonds at the moment because you're getting higher interest rates. And also, I don't want to elaborate too much on that because that's point number 10. But the point I wanted to make here is that, look here, I'm going to give some very, very, very simple statistics here. When you look at the Bloomberg US Aggregate Bond Index, right, and Aggregate Bond Index includes government-related issues, corporate bonds, agency mortgage-backed pass-throughs, etc. Bonds outperform stocks on these two indices for 11 out of the 42 years. Stocks have outperformed bonds in more, I'm presuming that's what it means, in more years. $100 invested in the S&P 500 in 1928 grew to $761,000 by 2021, while $100 in T-bills and T-bonds grew to about $2,000 and $8,000 respectively. And overall, we can come down here, the number of years that was positive and the outperformance. You are paid to take the risk that is inherently in the stock market. So yes, you can leave it on the table, and many people do, and many people should. If you don't like the risk that's in the stock market, leave it after you. But you will get paid less. There is lower return. But now they are indices. They are based on investing in an aggregate as distinct to individual stocks. And the last one, in my last 30 seconds, there are alternative options. Of course there is alternative options. Of course there is. And if you prefer to invest in property, go for it. If you prefer to invest in bonds, go for it. The thing about property is you're dealing with different liquidity. You can't just click your fingers and sell a stock. You can. You can't just click your fingers and sell a property, but you can when it comes to a stock. Or when it comes to bonds, then of course there is lower return. And of course we're looking at there's new things happening now. Apple are offering 4.15% at the moment, backed by Goldman Sachs from a saving point of view. Interactive brokers, I was on their earnings call last week. Interactive brokers currently are offering 4.33% on cash balances before it gets invested. We haven't seen these types of returns in ages and ages and ages. So they're there now, but for how long? So in summary, I wanted to talk to you about my take on volatility. Sell it and make it your friend. Market crashes, use market timing indicators. Complexity, just take a simple approach. Lack of control. Tailor your investing to you through Unisearch and put a stop loss in place. Emotional investing. Journal your way through and make your decisions before you have to make your decisions. High fees. Minimize your costs and learn from your lessons. Limited diversification. It doesn't have to be that way with ETFs. Time consuming. You can minimize your time. Just be consistent about it. Know what you're doing and commit to a meeting with yourself. Lack of guarantees, that's what you're being paid for. So either decide that's what you want to be paid for or leave it after you. And alternative options, of course there are. There are alternative options. If you want a place where there are returns on offer, where it is liquid, where it's a place that you can get in and get out and tailor it according to you, the stock market can be for you. If you want the property market with its illiquidity and differing type of returns and rental income, go for it. If you see high interest rates from somewhere that suits you better, go for it. But the stock market has an awful lot on offer. Woo! There you go. There are the 10 reasons that people don't invest, and there are my take on why I think there is a different perspective on them. My objective today is not to convince you to invest. My objective today is to help you understand why people look at things a certain way and how I look at them a certain way, and to give you some practical ways to overcome those if you want to. Thank you so much indeed for being here. If you liked the episode today, please push the like button so that other people can find out about this episode. I am going to be back to see you very, very soon, like super soon, because next week I am going to be a guest speaker on the International Forum. I'm going to be talking about the earnings releases that are all happening next week. I'll tell you all about that then. You're also going to hear from Stan. You're also going to hear from David Paul. We've got an action-packed session there. But if you haven't liked the channel and you haven't subscribed to the channel, press the call bell, do so that then automatically you will be made aware of what's coming and when. And the last thing is, if you want the follow-up notes from today's session, then also go to VectorVest.com/FFF, 3 Fs, and that is where you can subscribe to the mailing list that directly gets the insights directly from me. Okay, on that note, thanks so much indeed. Michael, I agree. Hit the like. Michael also says, Dr. Susan. I don't think I deserve that title yet, but thank you very much, Michael, to allay our collective fears. Well done. Mike says, thanks, Susan. Great presentation today. Maria says, great advice and information. Thank you. Badger says, great time slot and day of the week for you. Grab it and claim it as your own. Solid presentation today. I appreciate your effort. You're very, very welcome indeed. Thanks everyone for being here with me. I'm going to see you, like I say, next week for the International Forum. Thanks indeed to you all for being here. See you soon, and bye.